a real estate investor and paid over $50,000 in taxes last year, watch this before you file again. At that level, you're likely overpaying, not because you earn more, but because no one engineered your tax strategy. This isn't about earning more income. High earners don't automatically owe more tax. They owe more tax when strategy is missing. My name is Lisa Marie Odeja, and I'm a CPA and an enrolled agent, and I focus on advanced tax strategy for real estate investors. A lot of these concepts also apply to established business owners, but real estate investors are really my niche. My federal auditing background shaped how I think about structure, documentation, and long-term defensibility in real estate tax planning. So, on this channel, I break down how tax rules actually work and not the way they're usually explained online. And this is so you can make smarter decisions before filing season. In today's video, we're focusing on real estate investors earning $250,000 or more with a tax liability of $50,000 or more. If you're scaling, building a portfolio, and generating serious income, this conversation is for you. This is not for the basic W-2 filers taking the standard deduction. I'm speaking specifically to profitable real estate investors who need strategy, not just preparation. Here's what I see all the time. Rental income stacking up. No entity structure review. No cost segregation strategy. No income timing strategy. No proactive planning before year end. And then April comes, and the tax bill feels like punishment for being successful. Real estate is supposed to create leverage, not tax pressure. And what's difficult to watch is when I know a substantial portion of that tax could have been preserved if strategy had been implemented before the year closed. Let me give you a simple example. Say you net $300,000 from your rental portfolio. If structured correctly, you may qualify for the Qualified Business Income Deduction, also known as the QBI deduction, which can reduce up to 20% of your eligible business income. Now, that could mean a $60,000 deduction. Here is where investors lose money. If your income is too high and you haven't structured properly, you can phase out of that benefit. And that's not a filing issue, it's a planning issue. And planning has to happen before December 31st. Tax strategy is not about finding random deductions. It's about income positioning, entity alignment, timing, depreciation planning, multi-year forecasting, etc. And when you're paying $50,000 or more in taxes, even a 15 to 25% reduction is meaningful. That's not a write-off. That's wealth retention. If you do nothing, you'll probably keep earning more and paying more. The IRS reward strategy, it doesn't reward silence. If you don't know your exact tax liability from last year, I want you to pause this video and grab your return. Open your Form 1040 and go to line 24, total tax. That number right there is your total tax liability for the year. That's what you owe before any payments or refunds were applied. If that number is $50,000 or more, this conversation is for you. Now, here's the reality. For many of you, most of your 2025 tax outcome has already been determined. But 2026 hasn't. And this is exactly when proactive strategy makes the biggest difference. If you haven't had a proactive strategy conversation yet, now is the time to schedule it. Don't let next year's filing look like this one. If you've ever questioned whether your tax strategy is truly optimized, comment review below. I read every one. If this reflects your current tax position, you'll find a link below to schedule a brief strategy consultation. And on that call, we'll discuss your current structure, your goals, and determine whether we're a good fit to move forward. If you want more strategy-driven breakdowns like this, make sure you're subscribed so you don't miss future strategy breakdowns. And also, if this applies to someone in your real estate network, feel free to share it with them. Until next time, I'll see you in the next video. Thanks for watching.